Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, Paul. How's it going, man? Nice hat.
Good. How are you?
Are you in the Army?
Yeah, look at this. I represented the Army today. I got my Norwich sweatshirt on. So
Oh, look at that. I didn't even realize.
yeah,
I'm
I know.
representing too.
I noticed
Look at
right
that.
away. Like we're both representing.
The alma maters. Yeah.
Yep, that's right. Yeah,
Yeah.
very important. Of course, people
Nice.
see half my diploma on YouTube every week. So
I hope to have something behind me besides just this wooden propeller and a blank wall here pretty soon.
actually, that's Tammy's diploma. Never mind.
Well, she's the one that
Mine's-
actually earned it.
Mine's closer. It's over here.
Yeah. Well,
So-
speaking of your hat, I was just in Florida for a few days with some of the people that you know, doing some business, and Dale was there, and every single day he had a different Navy hat on.
Of course.
So I started calling him Old Navy.
there you go.
Yeah,
That's perfect.
it is. So
It's perfect.
yeah. Well, nice, man. Good. Yeah, I spent a few days in Marathon, Florida, which
Nice down there. Yeah.
way nicer than Minnesota this time of year. However, it was like 60 and windy, like 30-mile-an-hour sustained wind. So
Yeah.
I didn't get that beach weather that I was hoping for, but I guess technically it's still, they were like, oh yeah, we're participating in winter this year. It's 60 degrees and windy.
I think my parents, they've been in Southwest Florida since 2009. I don't think they've ever turned on their heat,
Wow.
ever.
Nice. That would save quite a pretty penny.
Yeah. And then the house in the summertime is just at a constant 74.
Yeah. Nice. Very cool, man. Yeah. Anything else going on? What's the update on the construction loan?
All right. Update on the construction loan is, so this week, and I think these folks, one of them communicates well. The guy that I brought in, who's just a rock star, brought him in just 2 weeks ago, and he's already basically where the other bank is. So I've got offers. Loans are both approved. Found out yesterday for one and the day before for the other that we were approved for both. I will likely just go with the lender that has better terms that are more favorable to me, and more favorable means slightly lower rate, and I keep 5% of my cash that I have to bring to closing. So one of the banks is 25%, one of them is 20%. So obviously I want to keep on, hold on to more of my cash as possible. So,
Right.
but so yeah, so I'm feeling way better about it than I was last time, for sure. But
Good.
It's been a grind, man.
Yeah. One that you'll never do again.
Right. No, that's exactly right. For those doing a construction loan, here's my recommendation. And this is not VA construction loans, or they do exist, but just for the broader audiences, if you plan on building a house someday, a single family home, plan on having what the cost of construction is, including the lot. So let's use round number. Let's say it's $1 million. Have $500 in cash when you go seek out lending.
50% in cash.
Have 50% in cash. Just
Wow.
have it.
And
may
not
need
not
it.
qualified funds, right? They wouldn't
Not
count your
qualified
funds.
money. No, so it depends. Sometimes they'll count it. Sometimes they won't. Like I had to send them the TSP terms for withdrawals and all that kind of stuff, and it really is up to human underwriting interpretation on whether they're going to count that as reserve funds or not. But our other friends ran into a problem, and it's a big no.
Yeah.
So I think for especially you military folks, it's something to think about. You've got 50% retirement at 20 years or 40% now, whatever it is with the blended system. There's not a strong case for locking up more money than you have to. So really take a look at that, because had I paid all that money that went into 401ks as premium over the years since I was a lieutenant in 2002, things would be a lot different.
Yeah.
So anyway, that's just real world experience right there.
Well, there you go. Thanks for sharing the pain. with us, and we can learn from what you're going through.
Yep.
So, well, cool, man.
With that, though, we have a question.
Yeah, what is
that
it?
came in from a listener, and this is great. This is a good question that I think a lot of people will relate to. So, without further ado, I'll paraphrase it here. Good day, David and Paul. So very polite.
Good day.
First, I want to thank you for your service. I have found great benefit from your podcast. Listen to every episode. That's in parentheses. Thank you for what you do in the IBC world. I have great appreciation for that. I have read Becoming Your Own Banker by the late, great Nelson Nash, and I am in the process of reading Building Your Warehouse of Wealth, his second book. My question is, I have a term policy on myself and my wife. Financial advisor 12 years ago said to get term and invest the difference. Well, that hasn't worked out very well.
Oh.
Imagine that. That's typical. I called the company, and I won't name the company, to find out if the term is convertible insurance. And it is. My question is, do I have to go with the company they recommend, or can anyone do this for me? As always, thank you for your time and knowledge on this matter. Have a blessed day, Rodney. So, Rodney, great question. Do you have any thoughts, Dave? I've got some thoughts because I already answered him via email, but I think we want to get his the thoughts kind of on the podcast because it's important for other people too. So,
yeah, I'm sure we probably have the same thoughts as usual, but just because you have a convertible term policy, first of all, good job getting convertible term instead of just regular term, because should you happen to be uninsurable right now and that's your only option, then at least you have an option to convert to permanent life insurance, right? However, if you are still insurable, there's no reason to convert a term policy with an inferior company for the purposes of infinite banking. There's no reason to do that versus start fresh. In either way, you're starting a brand new policy, a brand new whole life policy. So you might as well, if you're still insurable, work with an IBC practitioner who works with a very good IBC style company, or that this works very well
IBC friendly company.
IBC friendly, that's a great way to put it. And get yourself a nice specially designed whole life insurance dividend paying policy with a strong mutual company with a strong track record of dividends, and start your IBC journey there on the right foot.
Yep. Yeah, I don't think I could answer that any better, Rodney. So that's exactly what I would say. So, yeah, because there's no way of knowing. I don't think the companies that you listed here, and again, I'm not going to name them. I don't believe those are mutual companies. I could be wrong. I don't recognize them. I don't know anybody that writes business for them in the infinite banking world, and we know a lot of the infinite banking concept practitioners that are out there. So yeah, I think Dave gave you sage advice. I concur. I have nothing to add.
Yeah, listen to episode 18. That's where we talk about convertible term. I don't know necessarily. We probably cover that aspect that, hey, you may already have one. Doesn't mean you should convert it at that company. Now, maybe another question Rodney was trying to get at that wasn't explicit in what he asked is, can I convert this term policy with a different company? The answer is no.
No, you can't. That's right. Yeah, a lot of the companies have different underwriting guidelines. Even amongst the mutuals, some are a little bit more liberal than others. Some are more conservative. I prefer the more conservative ones, even though it can be a more lengthy underwriting process. But I know that they're exposed to less what we call in the industry adverse selection. So, I appreciate that as an owner of the company.
Absolutely. Cool. Well, good question. Keep sending them in, and we'll keep answering them.
Yeah. So, thanks for listening to every episode too. That's great.
Yeah, that's great. It's funny.
105 now, right?
Well, this will be 106, I believe. So, we are. I think last week's episode, even though it was episode 104, 105, that was actually right. Which 2 years is actually 104. 52 times 2, 104. But that last week's episode actually fell on closer to our anniversary of the very first episode we ever put out, which was on Valentine's Day, 2 years ago, 2022.
Right.
So, yeah. kind of big deal for us anyway. But anyway, moving on. So we've talked about one of our favorite Nelson Nash books, his second one, Building Your Warehouse of Wealth,
Yep.
which, we pay homage to Nelson with the name of this podcast. I like to think. But one of the things that came out in that book that has just stuck with me is so many times we, in this business, in infinite banking, this concept, we downplay the death benefit, the importance of the death benefit. Now, I don't think you and I necessarily do, but
Nope.
This concept overall, death benefit gets downplayed, right? Because we say, hey, we're trying to pay as much premium for as little death benefit as possible. That doesn't mean get less death benefit than you actually need for your family.
Yeah,
right.
It's simply misunderstood, Dave. I think. Nelson says that in Becoming Your Own Banker, right? A policy that prioritizes cash value accumulation over death benefit, but that doesn't mean that the death benefit's not important. You can't have cash value without death benefit.
Right.
And we can, this isn't a policy or an episode about policy design and base PUA ratios and all that nonsense. But the death benefits, of course, it's important.
It's the thing that makes everything else operate.
That's right.
So, I mean, that's what's guaranteeing your loans. And the fact is, the larger permanent death benefit you have, the larger amount of cash value you'll have.
Right. So you heard Dave used permanent death benefit, and he said permanent for a reason.
Right.
And, again, that's the PUA base discussion. But, and base premium drives the dividend too.
Yeah. But it also means that term rider that's on your policy, obviously it's not permanent. It's going to drop off at some point. So right. Don't just focus on that. Focus on the permanent amount of death benefit that you will have over time.
Yep.
Yeah. But this little example came out in Nelson's book, and I thought it was a really great question. And I like asking this. It's kind of rhetorical because hopefully everybody kind of understands where this question is leading. But let's imagine that you owned a machine, and this machine, kicked off, let's say $200,000 a year of income for your family. And you're Paul and my age, about 45. We're not quite 45, but we're close. We'll hit that this year. And you got about 20 years left of working years for those people who kind of have that, I'm going to stop producing and stop working at age 65. So you got about 20 years left. Well, this machine is kicking off $200,000. You need it to do so for the next 20 years. Would you insure that machine against, it breaking or malfunctioning, whatever? Like, would it make sense to insure that machine if it's creating $200,000 a year for you?
Of course.
Yeah, of course. Right. If so, then how much would you want to insure that for?
Well, as much as possible.
As much as possible. At a minimum, then.
At a minimum, it would be.
The
minimum would be 200, I suppose.
200 per year, but you need it for another 20 years. So let's multiply that by 20. So that's $4 million, right? At a minimum. Because, hey, I need this to provide income for my family for the next 20 years.
I'm counting on this thing.
I'm counting on it, right? So it makes sense to insure that machine if that's the machine that's actually producing the income that's feeding your family.
Right.
So the question is, what's the machine in your life? Obviously, nobody has a machine unless you're a counterfeiter or you work for the Fed. Nobody has a machine that's printing $200,000 a year.
You don't have the Beffert family money tree in the backyard, just blooming 20s?
Mm-hmm. Right. Go water that every day. Pick a couple 20s off.
Right. So we're the machine.
We're the machine. Yeah.
We're the machine.
Because without you, what else do you not have? If you're not producing the income, then you're the machine producing the income. Without you, there's no house, there's no car, there's no college savings, there's no retirement savings.
There's no vacation. There's no
vacation.
Boat, there's
nothing.
no comfort, I would
Yeah.
say.
So it only makes sense to insure the machine in your life, i.e., you, for at a minimum what you expect to produce up until the day you stop working. Right? That's logical in my opinion. But it's something that we don't really think about too much.
Yeah. Well, we were talking before we got on, before we hit record, about, if you knew in the next 5 years that your house was going to burn to the ground, you'd want to, of course, you're making sure you're required, because everyone's got a mortgage, don't you? So
Mm-hmm.
you all have to have full coverage on your house anyway. But if, let's say it was a car, you knew in the next 5 years you were guaranteed to have a crippling accident for that car, and it was going to total that car. Would you carry just liability? No, you'd carry full coverage. Of course you would, because you are smart. Well, it's the same thing about, what we're trying to get at here is we insure everything in our lives to the maximum amount possible allowed. So rebuild cost of this house, replacement cost, maybe 1 year newer or something, for some of those riders on automobile coverage. But we never fully insure our future income. And
Yeah.
I've heard plenty of people say it, well, I've got plenty in this and plenty in that. I'm going to have a couple of pensions. And that might be true for that particular family. And that's great.
Yeah. Or it might be true today.
It might be true.
Are those pensions
right.
guaranteed? Yeah.
Well, they're military pensions, so
So
I don't know.
I don't know either. It'd be political suicide to
Right.
cancel those, but
Not counting on it.
yeah.
But
Well, let's go back to.
But yeah, we don't.
You're talking about a house. Let's let's take that a step further. Let's say you knew, how long is a typical mortgage? 30 years. Most people have a conventional 30-year mortgage. When you're done with that mortgage and that you don't owe the bank any more money, is that a good time? Would you just cancel your home insurance?
Of course not.
Well, I mean, the bank requires you to have it until you pay the mortgage back. So once you're done, once you don't owe them any more money, you could probably get rid of that, right? But that's stupid.
Right.
Right? Because there's still, especially what if you knew guaranteed you were going to stay in this house for the rest of your life, but guaranteed at some point after you pay that 30-year, let's say sometime between 30 and 40 years, that house is guaranteed to burn down. You probably want to insure that for the maximum amount possible, right?
Yeah, even a future value if I could.
How is that any different than you? Like, you're going to die.
Right. Well,
Yeah.
it just goes back to the way you think, Dave, doesn't it?
Yeah. Yet you're being told, hey, you only insure yourself until, you're 65
Kids
and
are
you're
out
not,
of the house.
your kids are out of the house and you're not making, you're not working anymore. Then you don't need to. What sense does that make?
It doesn't. And we've already proved in past episodes, like real life, this strategy affects people in a negative way all the time. You just never hear about it, right? But
Yeah.
Oh, I'm no longer insurable and I want permanent insurance and I can't get it. Now I have no permanent income plan. God forbid my machine breaks, aka I'm dying. I died. I graduated, and now what? The surviving spouse has what?
What? Maybe they have your survivor benefit plan from the military, which is going to pay them like $2,000 a month,
right?
If they're lucky,
right?
Yeah. So we know there's two things. Everybody says there's two things in life that are guaranteed, right? Death and taxes.
That's right.
So you're going to die. You're going to have taxes. So why not try to mitigate both of those, offset the risk of both of those? Guess what? IBC can do that. One, you offset the risk of death financially to your family because they're going to inherit a windfall of income tax-free wealth. And taxes, hey, how about 20 years from now when you've had this policy for 20 years, you've got a large pool of capital that you could pull from tax-free for the rest of your life.
Yeah, that's right. Which is what a lot of people don't realize you can do. They don't realize how good these policies are and that they get better with age. Very few things in life get better with age, right? Very few things.
Yeah, I'd say.
Other than maybe whiskey and wine in some cases, right? Not Prosecco, though. You have to drink that within 18 months of bottling, I think. But anyway. Right. So why, I guess if that's all true, and it is,
Mm-hmm.
and I could take massive amounts of tax-free income in my retirement years, whatever that means, passive income years, wouldn't I want to put as much money into such a system as possible?
Yeah, you sound like Nelson.
Yeah. Yeah. It's not quite an exact quote, but it's close.
Yeah. So it kind of leads me to a lot of people have 401ks. I mean, most people who didn't learn about infinite banking until later in life probably have a significant 401k. Like you've been doing it for a number of years, and
Yours
maybe
truly included.
Yeah, right. So maybe you want to continue doing that because you get an employer. Maybe can argue with you about that. It's not. Hold on.
Dave just had some technical difficulties.
Yeah, my audio switched out. There we go.
There you go. Was that the original sound off? Did that just click off on you?
No, this came unhooked. My mic, so it went to the computer. Yeah,
you could definitely tell.
So there we go. Original sound back on.
Now you sound amazing again.
Thank you. Thank you. Okay. I got a voice that can make Wolverine purr. Right? One of my favorite Anchorman quotes. Anyway, so where I was going with that is in retirement, you're probably, most of our listeners probably have a 401k that they're going to have in retirement. Yep. Right? Well, think about this. In retirement, you're still going to want to pay your premium. Because let's say you've owned that policy for 20 years. 20 years from now, every dollar you pay in premium is creating $2, $3, $4 in cash value that you can access tax-free for the rest of your life. Where's a great place to fund your premium? Where's that income coming from? Pull it from your 401k. Yep. Funnel it into your premium. Boom. You've turned that, that tax liability of the 401k, which you still got to pay taxes on whatever you pull out of there.
Sure.
But now you put it into something before you spend it, put it into your premium, max out the PUA, whatever you can do, open up new policies for the grandkids or adult children, fund those. And now you've turned every dollar from your 401k into $2 or $3 of tax-free income that you can pull from immediately. Yeah.
Yeah. And again, folks, unless you own dividend paying whole life insurance, and you have some mature policies, like you've got some mature policies now, Dave, and mine are starting to be mature,
it's the only mature thing about us.
Yeah, that's also true. But they really do get better with age. And, I think I said in the last episode that we recorded that, I'm going to make this certain amount of payment and the cash value is going to go up by way more than the premium, which is just fantastic. And it's better than any place I could put money. That's
it really is.
It's not even close.
Yeah.
So anyway, yeah, I think that's a great use, especially every dollar in premiums producing $2 of cash value, maybe by year 20 or maybe a little bit more than that. That's phenomenal.
Yeah. Oftentimes more, man. If you start in your 30s, wow. Even if you start in your 50s, you're going to hit the point where every dollar where you have more available than you've ever put in. And in your retirement, you're going to be excited to make that payment because it's just going to increase your tax-free capital you can pull from.
Yeah. So that's a mindset shift too. I get excited to pay my premiums every year. And we've said that a million times in this podcast, but it's really true. I just paid. Oh yeah. You should have got paid on at least one of them by now.
I just got an email. Let me try to pull it up from a client. He said, actually, he gave us a nice quote. I'm going to throw a shout out to Ryan for this quote. He heard us say, he quoted us. One of us said, "You're better off learning nothing rather than learning the wrong thing." So
that sounds like you.
It sounds like me. Yeah, you're right. I don't know if an Army guy could have come up with that, but he said, this reminded me of a Thomas Jefferson quote, which says, quote, "I will add that the man who never looks into a newspaper is better informed than he who reads them, inasmuch as he who knows nothing is nearer to truth than he whose mind is filled with falsehoods and errors. So
It's kind of like, it's not what you don't know, it's what you think you know that just ain't so.
Right, which
is
which will lead you down the wrong path.
Yeah, for sure.
Yeah, but then he says, looking forward to my premium payment coming up, exclamation point. So he's excited. He can't wait to make that second premium payment.
Yeah, and it's just his second one.
Yeah, just a second payment.
They get better every time. The third one will be better than the second. The fourth will be better than the third. The fifth will be better than the fourth, etc. I mean,
absolutely. So
yeah, it really is. It really is great, just because you know it's going to happen. That cash value and death benefit's going to jump.
Yeah,
guaranteed.
Yep. And after every anniversary, feel free, contact the company for an in-force illustration, or if you're one of our clients, you could even contact us. But know that even if you can contact the company directly. But if you're a client of ours, contact us. We'll throw you an in-force illustration or walk through it with you and just let you know, hey, here's how it's looking right now. And yeah, it should excite you that you started it a year ago, right? I mean, this client I was talking about, it doesn't even feel like it was a year ago, close to a year ago that we started his policy. Like, time moves so fast.
Yeah.
Yeah.
It really does.
Yeah. I mean, I've been in Minnesota for 9 years now. This will be my 10th year.
Sorry to you Minnesotans.
This is my 10th winter here. Yeah. And it happens to be the mildest winter of all.
Yeah. I mean, you grew up in Kansas, though. It had bad winters there, too.
It did. It was wet and cold, wet and windy.
Yeah.
Like, it was really wet. So that wind really hurts.
Yeah.
Here it seems to be a bit drier.
Yeah. At least, where I grew up, you got snow.
Yeah. Well, I mean, if you look at the last Chiefs game, the AFC, was it the AFC Championship? No, the game before that, the divisional championships, when they played the Dolphins in Kansas City, it was like 20 below.
Yeah, it was cold.
So that was real cold.
Thanks.
So it definitely gets cold there. Yeah, the Midwest can be brutal. But that's why you're moving to Tennessee. One of the reasons.
It's a mild 4-season climate there, and it's pretty.
Yeah.
So.
Yeah. Well, I'm looking forward to seeing more updates on that construction. When does the construction actually get underway?
Well, if we close at the end of this month, it'll begin, probably that first week in March.
Nice.
So it still gives us enough time. Oh, that's the other thing. The bank I'm likely going to use has 18 months worth of construction loan time frame. Most banks are 12, and then you have to ask for an extension if they don't finish the home by the 12th month. So it kind of like gives us that breathing room for contingencies of, bad weather, whatever.
Yeah. Yeah. If you need them for Tennessee. Who knows? But, well, man, you got anything else on this topic?
I don't. We covered thinking. We had a nice analogy. I mean, it's great.
Yeah. We had a good analogy. Had good questions and feedback from some listeners and clients. Yeah.
Yep.
Yeah. Well, keep sending them in, and give us more topics to discuss. Every once in a while, somebody will say, hey, you guys should really, I would really love if you guys talked about this on an episode. So bring that forward. If there's something you want us to hit on again, let us know. Yeah,
it's either something that you all bring us or something that we hear out in the wide world that just kind of sparks, some triggers for us or whatever. So it, 105 episodes in, I always thought we'd kind of run out of things to talk about, but there's literally always something to talk about.
There always is. There always will be. So we'll take a different angle at the same thing. I like looking at other podcasts too and be like, oh, what do they think about this? There's disagreement out there. So not saying we're the only people you should listen to, but there's different ways to look at it. So do your own research, which we mandate basically that you do some research before we can even work with you. So read the books. If you want book recommendations, let us know. In the back of Nelson's book, there's always book recommendations. Like, I'm reading one that he recommended. It's a history book, so I had an Audible credit. I wanted to start reading it, and it's called...
Which one?
Churchill, Hitler, and the Unnecessary War. How Britain lost its empire and the West lost the world. So it's pretty fascinating, hearing it from a different perspective than what you learned in grade school. Right. That,
Right.
it was
Learned
noble
that
that
the
we
New
entered.
Deal was so great.
Oh, so great. Like, all these noble causes for war.
Social Security, so great.
Yeah. So anyway, expand your horizons, open your perspective to new ways of thinking, starting with becoming your own banker. It's all about the way you think.
That's
So,
right.
well, all right, everybody. Hey, have a good week, and drive safe if you're listening in the car, like most people are. And hey, until next week, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.